There's a company right now worth more than the entire economy of France. It doesn't make cars. It doesn't drill oil. It makes software that predicts the next word in a sentence. NVIDIA hit $3 trillion in market cap last year. Microsoft and Google aren't far behind. And the reason investors keep pouring money into these companies has almost nothing to do with what AI can actually do today. It has everything to do with a cycle that feeds itself. Because here's what's happening. AI companies raise billions. They spend those billions buying chips. The chip makers post record earnings. Their stock goes up. Investors see those earnings and think, this must mean AI is working. So they invest more. The AI companies raise more. They buy more chips. And the loop continues. But nobody's actually checking if the thing at the center of all this is profitable yet. Let's rewind to 2022. ChatGPT launches. It breaks the internet. Suddenly, every Fortune 500 CEO is in a board meeting being asked, what's our AI strategy? And if the answer is, we don't have one, the stock drops. So companies start spending, not because they figured out how AI makes them money, but because not spending makes them look obsolete. OpenAI raises $10 billion from Microsoft. Anthropic raises $7.5 billion. Google dumps billions into DeepMind. Meta burns tens of billions building infrastructure, and all of that money flows to the same place, NVIDIA. Because if you want to train a large language model, you need GPUs, lots of them. NVIDIA's H100 chips cost between $25,000 and $40,000 each. And you don't buy one, you buy thousands. OpenAI's GPT-4 reportedly used around 25,000 GPUs just for training. Google's models, more. Meta's Llama, more again. So NVIDIA's revenue explodes. In 2024 alone, they did over $60 billion in data center revenue. Their stock goes up 400% in 18 months. And here's where the feedback loop locks in. Investors look at NVIDIA's earnings and say, see, AI is real. The demand is massive, so they pour more money into AI startups. Those startups turn around and spend that money on more NVIDIA chips. NVIDIA's revenue climbs again, the stock climbs again, and the narrative gets stronger. AI is the future. The numbers prove it. Except the numbers prove something else entirely. They prove that people are spending money, not that they're making it back. Let's talk about what it actually costs to run these models. ChatGPT reportedly costs OpenAI around $700,000 a day to operate. That's rough math, but it's in the ballpark. Training GPT-4 probably cost over $100 million. Now, OpenAI has revenue. They're selling subscriptions at $20 a month. They have enterprise deals. By some estimates, they might hit $2 billion in revenue this year. Sounds good. Until you realize they're reportedly losing $5 billion annually. Anthropic, the company behind Claude, is in a similar position. Burning billions. Revenue growing, sure, but nowhere near profitability. Google and Microsoft can absorb these losses because they have other businesses printing cash. But the startups? They're entirely dependent on the next funding round. And the next funding round depends on the story holding together. Here's the story right now. AI is going to transform every industry. It's going to replace jobs, create new ones, unlock trillions in productivity. The models are getting better every year. Scaling works. More compute equals better results. All of that might be true, but none of it means these companies are worth what the market says they're worth. Because valuation in tech doesn't work like valuation in other industries. You're not buying cash flow. You're buying a narrative about future cash flow. And the narrative around AI is this: whoever leads in AI will control the next decade of technology. So even if these companies are losing money now, they'll make it back eventually. Therefore, any price is justified. This is the same logic that drove the dot-com bubble. Amazon survived, Pets.com didn't. The difference is, we don't know yet which AI companies are Amazon and which ones are Pets.com. Now let's add another layer, the chip shortage. NVIDIA can't make GPUs fast enough. Lead times are months. Companies are competing for supply. And when supply is constrained and demand is infinite, prices go up. So NVIDIA raises prices. The AI companies pay them. NVIDIA's margins expand. Their earnings beat expectations. The stock jumps again. And Wall Street analysts look at that jump and raise their price targets. Morgan Stanley says NVIDIA could hit $5 trillion. Goldman says $6. But here's the tension nobody's talking about. If AI companies can't figure out how to monetize these models, they'll stop buying chips. And if they stop buying chips, NVIDIA's revenue collapses. And if NVIDIA's revenue collapses, the whole AI valuation structure falls apart. Right now, the market is betting that won't happen. It's betting that AI will find product market fit at scale, that enterprises will pay billions for AI tools, that consumers will subscribe, that the productivity gains will justify the infrastructure spend. Maybe that's right, but the current math doesn't support it yet. Let's look at the corporate side. Every major company is announcing AI initiatives. Salesforce has Einstein GPT. Adobe has Firefly. Coca-Cola is using AI for marketing. JP Morgan is using it for compliance. But when you dig into earnings calls, the revenue impact is murky. Salesforce added AI features. Did it increase subscription prices proportionally? Not really. Adobe bundled AI into Creative Cloud. Did subscribers pay more? Some did. Most didn't. The problem is that AI right now is being sold as a feature, not a product. And features don't command the same margins as products. Microsoft is integrating Copilot into Office. They're charging $30 per user per month for it. Sounds great. Except most companies are still in pilot programs. Adoption is slow. And even when it scales, $30 a month doesn't cover the compute cost if every employee is hammering the model all day. So the economics are upside down. The infrastructure costs billions. The revenue is incremental. And the gap between the two is being filled by venture capital and public market enthusiasm. Now, you might be thinking, okay, but this is how new technology works. The internet wasn't profitable at first either. True. But the internet had a clear path to monetization: ads, e-commerce, SaaS. The business models emerged fast. AI's business model is still being figured out. Search engines make money from ads. But if AI answers your question directly, you don't click on ads. So Google's core business gets disrupted. Creative tools make money from subscriptions. But if AI generates the content, do you still need the subscription? Or does the AI company capture the value? Customer service makes money from labor arbitrage. But if AI replaces the call center, who gets paid? The software company? The enterprise? It's unclear. The monetization pathways exist, but they're not obvious yet. And in the meantime, the spending continues. Here's where it gets uncomfortable. The entire AI valuation boom is based on the assumption that these models will keep improving, that scaling laws hold, that throwing more compute at the problem will yield better results. And so far, that's been true. GPT-2 to GPT-3 was a massive leap. GPT-3 to GPT-4 was another. The models are better at reasoning, better at coding, better at nuance. But we're starting to hit diminishing returns. GPT-4 to GPT-4.5 wasn't a revolution, it was an iteration. The next models will be better, sure. But will they be 10 times better, 100 times better? And more importantly, will they be better enough to justify the cost? Because the cost curve is exponential. Training the next generation model might cost $1 billion. The one after that, $10 billion. At some point, the juice has to be worth the squeeze. Let's talk about the biggest risk nobody's pricing in. Regulation. Governments are starting to pay attention. The EU is drafting AI laws. The US is holding hearings. China is writing rules. And the more powerful these models get, the more scrutiny they'll face. What if training on copyrighted data gets banned? What if AI-generated content has to be labeled? What if compute gets taxed or restricted for environmental reasons? Any of those scenarios changes the economics overnight, and none of them are reflected in current valuations. So where does this leave us? You have companies worth trillions that aren't profitable. You have an infrastructure build-out that costs hundreds of billions. You have investors betting that AI will be the next internet. And you have a feedback loop where spending creates the appearance of success, which creates more spending. It's not a Ponzi scheme. The technology is real. The models work. The potential is legitimate. But the gap between potential and profit is enormous right now. And the longer that gap stays open, the more fragile the whole structure becomes. Here's the thing about feedback loops. They work in both directions. Right now, the loop is positive. Spending goes up, valuations go up, confidence goes up, spending goes up. But if one piece breaks, the loop reverses. If a major AI company folds, investor confidence cracks, funding dries up, chip orders drop, NVIDIA's revenue falls, the stock falls, valuations fall, more companies struggle, the loop accelerates downward. We've seen this before: crypto in 2022, SPACs in 2021, subprime in 2008. It doesn't mean AI is a bubble. It means the market is ahead of the fundamentals. And when markets get ahead of fundamentals, corrections happen. So what happens next? Maybe AI companies figure out monetization. Maybe enterprises start paying real money for real productivity gains. Maybe the models get good enough that the unit economics flip positive. Or maybe we're in the hype phase of a cycle that hasn't found its footing yet. Either way, the feedback loop will continue until it doesn't. And when it stops, we'll find out which valuations were justified and which ones were just a reflection of momentum. The uncomfortable truth is this: right now, the biggest proof that AI is valuable is that people are spending money on it. Not that it's making money, just that it's consuming it. And in finance, that's not usually how things end well.